All right, Srishti, thanks very much for walking us through today's trade, today's action on Dillard Street. Meanwhile, we're seeing the U.S. Treasury yields, the 10-year Treasury yields have been spiking and have hit a high of 4.35%. In fact, they've risen to a 16-year high now. We haven't seen them at these levels since 2007. So does it mean that Indian markets are going to now have to brace for FPI outflows? Is it far from certain that this is going to happen or not, that's the eventuality? Because a lot is going to depend on how the Fed moves on interest rates and whether or not we're going to get any signs from what Fed Chair Jerome Powell says at the Jackson Hole Summit is going to be very closely watched by investors. Domestic money is going to keep the Nifty away from corrections is also something that we are considering. But let's pose these questions to Geoff Dennis, independent emerging markets commentator, is joining us on the show. Geoff, great to have you with us. Do tell us, in your understanding right now, if these sustained levels of spikes that we are seeing as far as the 10-year U.S. Treasury yields are concerned, do you think those are going to remain at elevated levels? And if so, is money going to get pulled out of emerging markets like India? What's your reading?
I think the answer to those two questions are yes and no. First of all, I think interest bond yields are going to stay relatively high for a while. They've gone up sharply, as everybody knows, in the last few months, including in August itself. You put that down to two things. First of all, the persistence of a reasonably robust economy in the U.S. When don't seem to be getting this soft landing that, or the fear of recession has subsided. Perhaps that's a better way to put it. And that's pushing bond yields up. Also, there's a renewed worry about supply because, of course, of the very wide U.S. budget deficit. So I think it's a combination of those two. Now, this is a global phenomenon. Of course, the U.S. bond yields may be leading the way. But in this environment where the fundamentals in India are very strong indeed, as far as I'm concerned, I think a lot of global investors feel that, especially with all the problems that China's having. I don't see this leading to a major outflow of foreign money from India at this stage.
Do you think that anything that Jerome Powell would say at the Jackson Hole Summit is going to change the course, as it were, of the markets? Will he pronounce a statement that may even suggest any decision on rates that may not be data dependent? Is that a likelihood even?
I doubt it. I think he's not, because he typically doesn't opine on the short-term outlook for interest rates, because what everybody wants to know, of course, is, are we at the peak? Is there one more to go? Is there two more to go? Whatever. My own gut feel is that we're either at the peak or there may be one more to go. I think what's more likely, he's going to emphasize the need for inflation eventually to return to 2%, which, by the way, is not going to happen in the second half of 2023. I've argued for some time that June may well have been the trough for inflation year-on-year headline at 3%. We already see it tick up a little bit in July. So if the 2% goal is really what Chairman Powell wants to focus on, we've got to look for that move towards 2% to happen, if you like, early next year or in the first half of next year. So I think he's going to be sketching more of a long-term outlook and the importance of the 2% inflation target, rather than giving us a real steer, if you like, on what may happen at the next meeting. He's going to stay tough in the sense that he's going to say there's been a lot of progress on inflation coming down, but with the job is not finished, and that possibly implies perhaps one more rate hike.
Geoff, going by the inflation print of late, the kind of stance that the Fed has upheld, indeed the resilience of the American economy as well, which is, in a sense, good for the global economy. How do you think bond yields are going to move in the near term? Will they stay at the elevated levels that they are? And how is that going to play out on the US dollar, which seems to be losing some steam of late against peers and definitely against the Indian rupee as well?
Well, I'm not sure that's right, because, in fact, we were looking at the dollar quite a bit stronger, quite a bit weaker than it is today. Just several weeks ago, it's rallied quite a bit of late on the back of the rise in U.S. bond yields, and indeed the expectation the Fed may have more to do. And I think this is complicating the emerging market story, because Obviously, as I've argued many times, the EM does not tend to attract money when the dollar is strong. And you've just gone through 8 successive down days for emerging market. The emerging market index, of course, not helped by the big problems that are in China. Now, I think if we do get some definitive evidence shortly that the Fed is done in terms of interest rate hikes, which I think is probably going to be the case at some point over the next 2 to 3 months or so, and there's a prospect of lower inflation in 2024, I think the bond yield increase will taper off. And then you'll probably see money coming back into the emerging market. So I'm still bullish about EM here because we've had a big sell-off. This is a good entry point. But I think the decline in yields that will come eventually is probably a few weeks or even a few months down the road. And I think yields stay high for now until we get a better idea of when inflation really will come down further and when the Fed is finished with its tightening.
Yes, indeed. That remains a big question. How soon are we going to see a pause as far as, well, we've seen a pause, but whether we are going to see a reverse kind of situation happen anytime soon in the US is something that investors will be watching very closely. Aditya is joining us too. Aditya Shah, the founder of Hercules Advisors. Great to have you, Aditya. Tell us, Geoff strongly believes that, the Indian markets are pretty insulated, perhaps, to what's going on in the rest of the world. We are seeing these bond yields spike, and the big question to ask is whether we are going to see capital outflows, foreign capital outflows from India, and whether that's going to cause any kind of correction in the markets. I know that you strongly feel that domestic demand is going to keep driving up the Nifty, but is that something that you see happening even now when we are seeing this kind of spike in US Treasury yields?
In 2022, a lot of FIIs pulled out money from the Indian markets, and the Indian markets not correct much. So we are in a phase where financialization of savings within the country is going on very strongly, and we are taking up ownership of our own Indian markets as compared to the FII market. Having said that, FIIs are also very important for the Indian market. I feel that the FIIs are now slowly and steadily realizing the potential of the Indian market, how strong India's demographics really are, and how strongly the Indian economy will grow over the next 5, 7, 10 years. So I feel this is a very short-term phenomenon where the US Fed will hike interest rates for the next 2 to 3 months, and then we will see an interest rate cut cycle maybe in the starting part of next year. But I don't feel that anybody who has got a long-term view on the Indian markets will have anything to do with these Fed rate cuts. In my opinion, if the market shows any correction, I feel both the DIIs and the FIIs will be wanting to pour money into the market because the next 5, 10 year story continues to be very bright for the Indian economy.
Thanks, Aditya and Geoff, for joining us with your perspective on the markets right now with these 10-year bond yields surging. It does bring to mind an important question while we are seeing those kind of corrections play out in the markets, but whether or not they're going to have a prolonged effect is something that is on our radar. Thanks very much for joining us with your perspective tonight. Let's talk about